Today. A little bit about us. So we run $8 billion today across 30 portfolios, 20 custom insto mandates and 10 public funds. Coolabah has the largest team in active investment grade fixed income. So we have 38 execs, including 12 traders and PMs and 12 analysts, spread between London, Sydney and Melbourne. We have about 9 guys in London, including 4 traders in London. Why do we need such a big team? Because we're very active in trading global bonds. So we'll show you the data soon, but typically we're trading 50 to 100 times a day. Typically we're turning over $300 to $400 million a day, and we typically have no transaction costs. So our RG97 numbers for indirect costs are normally near zero or negative. Why? Because we're earning the bid-offer spread rather than paying away the bid-offer spread. So in terms of what we actually do, in fixed income, 99.9% of the world works one way. They have a big bond portfolio, they hold to maturity, they're very static, and they'll drive yield through one of 3 levers. The first is illiquidity. Take illiquidity risk, invest in loans, you get paid more yield. The second lever is default risk. If you load up on default risk, you should be paid more yield. The third lever is obviously interest rate risk, or so-called duration. Again, more duration risk, more yield. What we do is very different. Typically, we only run 0 duration portfolios, so they're all floating rate. We have one long duration strategy that I'll talk about that is class leading since inception, but otherwise our portfolios are all 100% floating rate, not short duration, literally 0 duration. Secondly, we don't like to carry any credit risk. Typically, the average credit rating in our portfolios is A+ to AA, and we typically only have 80 to 150 very active positions. The final point is we have no illiquidity. Our holding periods are measured literally in days. Our active composite bond strategy, we turn over 7 times a year. Our long-short credit fund, we turn over 20 times a year. Normal turnover for a bond fund manager would be about 0.5 times a year. So if we're getting no duration, we're getting no illiquidity, and we're getting no credit risk, how are we generating returns? What we do is we today apply 60 to 80 proprietary bond valuation models. These models are literally revaluing every security that's investment grade and tradable on the planet every minute of the day, and we're hunting mispricings. What are bond mispricings? We're looking for securities that are paying too much interest for their risk factors. So our models will control for their term to maturity, their credit rating, their liquidity, their position in the capital structure, and we want to buy, say, a CBA bond paying 7% that our models are saying should only pay, hypothetically, 6%. And if that spread compresses, we'll earn for that particular security up to 5 percentage points of capital gain on top of the yield. Conversely, we want to short bonds that are not paying enough interest and profit from widening spreads. So in March 2020, we were shorting Virgin senior bonds. Virgin Airlines obviously went bust. They were a common holding position for many Australian credit funds. And in 2022, we were shorting Credit Suisse senior bonds. Obviously, again, Credit Suisse was a big holding for a lot of yield-chasing Aussie credit funds. In fact, we had a blanket ban on going long Credit Suisse in May 2021. I wrote to Twiggy Forrest, who transferred $1 billion to Credit Suisse's private bank, Chatham House Rules, in February 2021. And 5 times and said, you need to get out. No disrespect to any Credit Suisse private bankers in the room. So just to look at the efficacy of this trading, what I've put up here is, since January 2021, every single new bond issue trade we've done in Australia. So this is just Aussie dollars. So we've traded 4 billion of new issues. We've made money 99% of the time. The horizontal axis is time, the vertical axis is return. We have generated an IRR that's very, very high, north of 30%, because our holding periods are only under 8 days. In US dollars and euros, we're looking at $4.8 billion of all primary or new issue trades. So this is every new issue trade since January 21. so over the last 2.5 years. Again, we win 90% of the time, not 99%, so our hit rate is actually lower in US credit and euros because those markets are more efficient. And our holding periods are much shorter because, again, we get mean reversion much faster. Rather than holding for 8 days, we're only holding for 3 days. Probably shouldn't tell the bond issuers that. The IRRs, though, are very, very high. So this is on the long side of the book. What about the short side of the book? In late 21, as Cormac mentioned, we said that we thought US 10-year yields would have to rise from 1% to north of 3.2%. We thought the Fed would have to hike beyond 3%. At the time, the market was saying the peak in the Fed hiking cycle would be just 1%. We argued US equities would have to fall by more than 30%. S&P fell 26, NASDAQ fell 36, and we argued credit spreads would have to blow 100 to 150 wider. So we were super negative duration, super negative on credit, and we put $8 billion, well, actually you can see them all here, we put $4 billion, $4.3 billion of physical credit shorts into our books through something called reverse repo. Basically we were short selling Goldman Sachs, Citi, BAML, Barclays, BNP, Societe Generale, Deutsche in US dollars and euros. And these are all the shorts we did. 4.3 billion of trades. We made money 83% of the time. The IRR was over 6%. Holding period was 21 days. So there are physical bond shorts in Aussie dollars, US dollars and euros. And then we were also short through trading index credit default swaps, one of the most liquid securities on the planet. And through index CDS, we were shorting US investment grade bonds, US high yield, European high yield, and European investment grade. We were also shorting Aussie investment grade. So you're looking at $12 billion of trades. We made money 80% of the time. The IRR was over 8%. The typical holding period was 11 days. To look at the sheer velocity of our trading, this is just since 1 January last year. We've executed $117 billion of trades in bond and credit markets in US dollars, euros, and Aussie dollars. Again, this is why I need 12 traders and PMs, 12 analysts and 38 staff, and why we're opening up a US office shortly. But you can see month by month our buys versus sells, they're pretty evenly matched. We recently entered the sovereign market. We'd been credit traders, originally Aussie credit traders and US and Euro credit traders, and now we're trading state government bonds and Commonwealth government bonds. We're actually shorting the states right now, off the record. Not a very big position, so I'm happy to discuss it. It's only about 125 million. So we've started going long and short Commonwealth government bonds. We have 19 different proprietary valuation models we've built in-house. We tested these models, I think we have this chart, no we don't. We tested these models for 2 years, and basically what we're doing is we're building a Commonwealth government bond curve, and we are looking for cheap bonds paying too much interest, and then we're looking for, and we go long those bonds, hedge out the interest rate risk, and then we're looking for expensive bonds that are not paying enough interest, and we go short those bonds and hedge out the interest rate risk. So these are Commonwealth government bonds. They're AAA rated. Once you hedge out the rate risk, you're basically trading cash. So think about that. We're going long and short cash, and we're doing a lot of this. So we launched the strategy with Gusto on the 1st of November. We've actionized it or implemented it across most of our long-short portfolios. The red line here is the track record. These are the daily returns, the red line. This is Aussie equities, the brown line. The green line is the composite bond index. This is floating rate notes, the blue line. And the pink line is cash. So the performance of that particular long-short AAA rated sovereign strategy, no equity risk, no credit beta, no default risk, infinitely liquid, has been very strong. It's delivered 12.6%. It's annualizing at 18%. Its volatility has been 4%, and its Sharpe ratio has been 3%, and it's beaten the other asset classes. In terms of the correlations to the other asset classes, they're basically zero. So zero correlation to cash, composite bond, as in fixed rate bonds, zero correlation to floating rate notes, and near zero correlation to equities. In terms of, you might say, Chris, you probably only got 100 million bucks in this. So you juicing these numbers. Actually, we've done, this is all the trades we've done in this strategy. So we've done $17.4 billion of trades, and the hit rate has been 77%. I'd expect the hit rate to be lower in Commonwealth government bonds than bank bonds and corporate bonds and ABS and RMBS because it's more efficient. But that's the data. Okay, now moving to macro quickly. Oh, actually, not yet to macro. Just the existential challenge for you guys, I think right now, is the fact that risk-free rates have risen. You can now get 7% interest rates on CBA bank bonds. You can get 5.5% interest rates on CBA senior bonds. CBA shares, which are 15 times leverage, are only paying a franked yield of 5.9%. So the franked yield is 5.9%, the cash yield is 4%, the equity, CBA stock, is 15 times levered, but on CBA bonds, you're getting 7%. That doesn't really make sense to us. Our super fund clients are saying, load up us with as much senior and tier 2 from big, globally important, too big to fail banks as you can get. We have clients that want to buy up to $700 million exposure per bond. And I think this presents a huge problem for other asset classes. Commercial property yielding 4.5%, resi property yielding 4%, Aussie equities yielding 6%. It's just not good enough when you can get 7% on basically bank bonds with no default risk and no liquidity risk. If we look at the move in the interest rates on these bonds, here on the left-hand side, you've got CBA senior bonds. We're paying 0.25% interest in 2021. They're now paying 5.5%. CBA Tier 2 bonds were paying 1.25% interest in 2021. They're now paying 6.5%. In terms of the yields on our portfolios, these are a few strategies we run. Our new floating rate high yield fund, which has attracted a lot of interest, is only bank bonds. They are geared. We're currently yielding 9%. These are A-rated floating rate bonds, no fixed rate bonds, all Aussie dollars. 80% of the portfolio is major bank bonds. 20% is Suncorp, Macquarie, Bendigo and BOQ. Our long-short credit strategy is yielding about 8%. HBRD is yielding about 7%, our composite bond strategy is yielding 6.6%, and our cash enhanced funds are yielding about 5.5%. In terms of the change in the yield on our portfolios, same sort of story. In 2021, the yields were about 1% on our zero duration cash enhanced fund, Smarter Money, Higher Income. It's now 5.6%. On our long duration active composite bond strategy, the yield's gone from 1.5% to 6.6%. In terms of 6-month and 12-month returns, recently, very strong. Our long-short credit fund over the last 6 months has done about 8% pre-fees, so annualising at about 16% gross. Our new floating rate high yield fund has done about 6.2% pre-fees, annualising at 12 to 13% gross. The nets have been around 6.4 and 5.7. Our active composite bond strategy has also done well. Last 6 months, 4.2 versus the index has done 1.5. Over the last 12 months, similar story. Our long-short credit funds returned 10.4% pre-fees, about 8.5% post-fees. Our floating rate high yield fund was only launched in the last 6 months, so we don't have 12-month returns for that, but our active composite bond strategy did 4.5% over the last 12 months versus the index at 1.2, and our cash enhanced funds are all doing about 4 to 5, and we'd expect over the next 12 months for them to do about 6 to 7. In terms of the floating rate high yield fund, just a little bit more detail. So this is the yield on the portfolio, the yellow bar, about 9%. You can get 9% on high yield. The idea here is to use leverage via repo. What is repo? Repo is borrowing from the RBA. So we literally borrow via 8 banks from the RBA at a cost of about 10 to 20 basis points over cash. So we're borrowing off, say, CBA at 4.2%, and I'm giving CBA $100 million into a senior bond where they're paying me 5.5%, or I'm giving it to ANZ in a tier 2 bond and they're paying me 7%. Daily liquidity, no performance fee. You do have mark-to-market volatility, but you don't have default risk and you don't have illiquidity risk. Our active composite bond strategy, I think, is also relevant and has attracted a lot of interest. So this is our only long duration strategy. It was created for a super fund in 2017. We fixed the interest rate duration at the index duration. So our net of fee returns are the blue bars, and the black bars are peers, and the red bar is the composite bond index. This is since inception, and the blue bar duration is set at 5.2 years, or index duration, so we can't mess with that. When you buy the composite bond strategy, you're getting composite bond duration. But where we add value is through active trading, and you can see over the last 5 years, net of fees, we've substantially outperformed every single peer in the market and the index. Over the last 3 years, duration got destroyed. We were negative on duration in late 2021, but we still beat all peers in the index. Over the last 12 months, again, net of fees, we beat all peers and the index. What's most important is our risk-adjusted returns, measured by, say, a Sharpe ratio. The blue line are higher than the index. So the Sharpe ratio is excess return above cash divided by volatility. Our blue line is above the index's Sharpe ratio. And the Sortino ratio is excess return above cash divided by downside volatility. So our risk-adjusted return is better than the index. And our risk-adjusted returns are also better than every single peer that we're aware of. Finally, just quickly on macro, I haven't got much more time. Key points are, this tightening cycle is very different to prior cycles. We're starting off with lower rates, much higher inflation, and much lower unemployment. We've never seen a cycle like this. Goods inflation is normalised, but services inflation remains profoundly problematic, and unemployment rates have barely budged despite huge increases in interest rates. That services inflation is demand-side inflation, and it's being driven by something called I hate using jargon, but it's being driven by unit labour costs. This is wage growth less productivity. All you need to know is it's the wage cost of businesses producing products, right? In Australia, it's running at 8%, in Europe, 6 to 7, in the US, 5 to 6. And this is what is driving services inflation. This is why the inflation battle that has been raging since mid-21, and we're now mid-23, will continue to rage for some time yet. We don't think there are any myopic or hedonistic quick fixes. We think this will be an iterative, multi-year battle against inflation. We are confident that we're going to see recessions as defined by a 1 percentage point increase in unemployment. So unemployment will increase and the central banks are going to march forward until they crush inflation. Don't believe this BS around them having dual mandates and being worried about increasing unemployment. They're not worried about increasing unemployment. We also have elevated inflation expectations. Equity guys will tell you inflation expectations are well anchored, but here we can see short-term inflation expectations for the US, Europe and Australia, and they're all substantially elevated. The final point, or one of the final points, is that whilst it might feel tough here in Australia with a 4.1% cash rate, the RBA's latest estimates are that the neutral or normal cash rate is just 3.8%. So the RBA is barely above neutral according to its own modelling. This is not Chris Joye speaking. This is the RBA's best research. And the RBA thinks it needs to get to 5%, or specifically 4.8%, to get inflation back to target in 2026. 2026 is too far away. And so the RBA is likely to have to raise rates materially, which is obviously going to create additional stress throughout the economy. Our modelling points to a recession in the US and Europe in late 23-24. We also think we're going to get a recession here in Australia. One of the big problems is this thing we've never seen before, which is the size of the consumer buffers. Because of the pandemic and the lockdown of cities, whereby households were not allowed to save, and because of the huge fiscal transfers from Victoria, New South Wales to households, etc., households have built these massive cash buffers. The blue line are the Aussie cash buffers. The pink line up here, is the US cash buffers, and these are the European cash buffers. And these cash buffers are latent demand. We are going to burn through them, but they are slowing down the wheels of monetary policy, combined with the fact that about 40% of all home loans were fixed rate rather than variable rate due to the advent of the RBA's fixed term funding facility. That's the $190 billion they lent to banks for 3-year terms. So the bottom line is it's likely to be an iterative, elongated cycle. Rates are heading higher. There's likely to be significant additional pain. We're seeing that in the form of much higher default rates. So here in the blue line, we have Aussie non-bank home loan default rates, and the green line is bank default rates. These are 30-day delinquencies, and we've seen a very sharp increase in non-bank 30-day delinquencies. We've only seen a very benign increase in bank delinquencies. And when we look at just prime non-bank home loans, which is the blue line, versus prime bank loans, so we exclude all the subprime or non-conforming loans, we still see a quite striking, potentially catastrophic increase in very 30-day plus arrears for non-banks, which is probably an artefact of the fact they're not regulated by APRA, whereas the banks are subject to much tougher standards. We're also seeing significant stress in the construction industry, which is the bottom left-hand side chart. So this is the proportion of monthly construction businesses going broke. So we're seeing lots of delinquencies in construction and in hospitality. Aussie insolvencies are the highest since 2015. US insolvencies are the highest since 2010. And global corporate defaults are also now rising above long-term averages. All of this means that portfolio construction for the next 10 years is likely to have to look very, very different to portfolio construction that we've used in the last decade. Thank you very much.
Thank you, CJ. Don't go anywhere.